as the market has already passed the 15,500 level of the Nifty index and is flirting with the 15,000 levels, let's do a summary of some of the key indicators to review the state of our economy and the current market valuation. The shortage of global supply chain has become the cornerstone of a high inflationary scenario. There is a flurry of factors contributing to the global supply chain crisis, such as adverse weather conditions, pandemics, geopolitical tensions, and a resurgence in the demand. The world has faced a shortage of random goods, from coal shortages and chip shortages in India, lettuce in Australia, onions and salami in Japan, bottled beer in Germany, and even wheat shortages around the globe. While on the one hand, supply-led inflation is wreaking havoc, the effect of global central bank rate hikes to control inflation has begun to show its impact on the demand. The slowdown in demand is evidenced by the drop in the prices of iron ore and Brent crude oil. Iron ore prices in China dropped dramatically by more than 8% to 774 yuan per ton due to deteriorating demand for steel in China. The price of Brent crude fell more than 5% to approximately $113 per barrel and now to about 107 per barrel. India's May inflation numbers show signs of moderation and rural inflation has dropped dramatically. Although inflation in India appears to have peaked in April, estimated inflation for fiscal year 2023 is likely to remain around 6.5%. The IIP rose higher in April to 7.1%, mainly due to base effect. However, manufacturing, consumer durables, and capital goods continue to maintain weak underlying momentum. India's trade deficit for May increased by about $4 billion to $24.3 billion, driven by high commodity imports. Export prospects are clouded by growing risks to global growth, while oil prices remain high, slowing global and domestic growth in an environment of increasingly aggressive central banks. High oil prices and headwinds to exports are clouding the outlook. Several brokerage firms across India are reducing Nifty's estimate earnings for FY23 by approximately 18% and estimated earnings for FY24 by 13%. The market valuation is very close to -1 standard deviation of the 1-year forward PE band and is trading at 18.3 times. Looking at valuation, we believe much of the effect of the slowdown has been incorporated in the valuation. However, markets may continue to see more FII selling on the back of persistence of geopolitical tensions and direct and indirect impact of high global commodity prices, especially crude oil prices, and the risks of further pass-through to domestic pump prices despite recent excise duty cuts and rising commodity prices along with a weakening INR. Experience shows that equity markets declined by 10 to 15% in the 3 to 6 months following a US federal policy reversals in 2012-13. However, the equity markets produced positive returns over the next year. Long-term investors should start investing once the business cycle reaches the end of the cycle from the current mid-cycle and verify technical levels to enter the market at the right time. All in all, bearing in mind the economic slowdown, investors' attention should shift to quality large cap stocks. Now, I hand it over to our technical expert, Mr. Kapil Mokashi, to get his opinion on the markets. This is Shah signing out. Happy investing.
Hi everyone. My colleague Viral has discussed fundamental update on the markets. Let us have a quick technical check on the index and the view going forward based on the charts. Since the view would be from the perspective of 3 to 4 months, we would be mainly using monthly, quarterly and half-yearly charts for analysis. On the quarterly time frame charts, after forming back-to-back indecisive doji candles, Nifty has formed a strong bodied candle around the upper end of the band, a strong bodied red candle, as you can see over here. If you go one time frame higher on the half-yearly time frame charts, we see more or less a similar formation. In fact, we have a green candle closing above the upper end of the band, and immediately you have a red candle closing below the upper end of the band. Now historically, whenever such combination has appeared in the past on the half yearly time frame charts, markets have either given a strong price correction or they have given a time correction. Now time correction simply means markets moving sideways and consolidating for a much longer duration. If I go to the monthly time frame charts of Nifty, Nifty is currently seen trading inside a monthly demand zone. Now there are two levels close by here. We call it a level and top of a level, and market is currently seen reacting from the second monthly demand zone. Now our view is, as long as this monthly demand zone holds, there is some hope for the bulls. Now it doesn't necessarily mean that markets will go on to make newer highs or fresh highs, but what we simply mean is we would expect markets to consolidate or stay sideways for the coming quarters as long as we remain above that level. We would only be a little worried or cautious if Nifty closes below the levels of 14,890 on the monthly time frame charts, as that would mean markets have pierced deep inside the monthly demand zone and probability of breaking that monthly demand zone would increase substantially. So technically, we would be closely watching the level of 14,890, 14,900 on the monthly time frame charts, which is very close to the psychological level of 15,000 on the index. The odds of market staying range bound are very high as long as we remain above this level. In the meanwhile, we would highly suggest being stock specific and concentrate on those stocks which are already trading closer to their higher time frame demand levels. Some of the stocks we have already discussed in our previous videos. So keep a close watch on the given levels of the Nifty. Till then, thank you very much for watching us, and we would look forward to seeing you soon. Don't forget to subscribe to our channel and put your comments on the comment section below. Please click on the bell icon so that you get regular notification whenever we post our videos. Thank you.
This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing.